Every generation thinks its crash is the worst, but history has an answer. The biggest market crash in history wasn't just a bad day on Wall Street. It was a 4-year catastrophe that erased almost 9/10 of the entire stock market, wiped out fortunes, and plunged the world into the Great Depression. This is the story of the crash of 1929, and why, more than 90 years later, it still stands as the biggest market crash ever. It started with a boom like nothing the world had seen, the Roaring '20s. From 1921 to 1929, the Dow Jones Industrial Average rose sixfold, climbing from just 63 points to an all-time high of 381 in September 1929. Everyone wanted in. Tax cuts, cheap credit, and the new miracle of electricity and radio fueled a frenzy of speculation. Ordinary people poured their life savings into stocks, and, more dangerously, millions borrowed money to buy stocks on margin, putting down as little as 10% in cash and borrowing the rest. When stocks kept rising, the leverage made people rich overnight. It seemed like the party would never end. But it always does. The first warning signs came in September, when stocks quietly started to slip. Yet the speculation continued. Then, on Thursday, October 24, 1929, Black Thursday, panic hit the floor of the New York Stock Exchange. In the first 3 minutes of trading, nearly 3 million shares changed hands, and wealth worth $2 billion evaporated. 12.9 million shares traded that day, a record. The real collapse came on the following Monday and Tuesday. On Black Monday, October 28th, the Dow plunged 12.8%. The next day, Black Tuesday, it fell another 11.7% as a staggering 16 million shares were dumped. In just 2 days, the market lost nearly a quarter of its entire value, the worst 2-day crash in American history, a record that still stands today. By mid-November, the Dow had lost almost half its value, falling to 198. Wall Street was in ruins.
The crash of 1929 did not end with one bad month. It cascaded into the worst economic disaster of the 20th century. As panicked investors pulled their money from banks, thousands of banks failed. Businesses closed, factories shuttered, and unemployment soared to 25%. The stock market kept sinking for years. By the summer of 1932, the Dow had fallen all the way to just 41 points, 89% below its 1929 peak. It was the lowest level of the 20th century and the worst crash in recorded market history. An investor who put $100 into the market in 1929 watched it shrink to about $11. The damage was so severe that the Dow did not return to its pre-crash high until November 1954, 25 long years later. Anyone who bought at the top in 1929 had to wait a generation just to break even. That is why 1929 remains the gold standard for a market crash. No single day since has matched the depth, duration, and destruction of the Great Crash and the Depression that followed it.
But if you ask what the single worst trading day was, history points somewhere else. On Monday, October 19th, 1987, Black Monday, the Dow Jones fell 22.6% in a single session, the largest one-day percentage drop in history. The S&P 500 fell 20%. The crash was global, hitting Hong Kong, London, and Berlin. New portfolio insurance trading strategies and program selling amplified the panic into a cascade. The surprising part? The 1987 crash was over almost as fast as it began. Because the Federal Reserve stepped in immediately, slashing interest rates and promising to back the financial system, the economy never fell into recession, and the market recovered within 2 years. It was a terrifying day, but a shallow scar. 21 years later came the Great Recession, the biggest crash since 1929. In 2008, the collapse of the housing bubble and reckless mortgage-backed securities brought down the giants of Wall Street. In September 2008, Lehman Brothers filed for bankruptcy, the largest in American history, and panic gripped global markets. In a single week, the market fell almost 9% in one day, then nearly 9% again in October and again in December. The Dow fell more than 777 points in a single session. From its peak in October 2007, the S&P 500 crashed about 57% into March 2009. Trillions of dollars of wealth vanished, and the global economy tipped into the deepest recession since the Depression. It took until 2013, 6 long years, for the market to climb back to its old high.
Then came 2020. The COVID-19 pandemic triggered the fastest crash on record. In just over a month, the S&P 500 plunged about 34% from its February peak. On March 16, 2020, the Dow dropped a record 2,997 points in a single day, nearly 13%, the largest point drop in history. But this crash was different. Massive government stimulus and central bank support produced the fastest recovery on record. The market clawed back all of its losses in just 4 months. So which was truly the biggest? If you measure by a single day, it was 1987. If you measure by speed, it was 2020. But if you measure by cumulative loss, depth, and lasting damage, the crash of 1929 wins by a landslide, and it isn't close. Here is the lesson that has never changed. Markets crash when speculation outruns reality. Leverage makes the fall faster, and the people who panic at the bottom lose the most. History doesn't repeat, but it rhymes. The biggest crash ever already happened, and the next one will feel just as inevitable. Thanks for watching.